All right. Well, welcome to the Boring Millionaire podcast. My name is James Lamantia.
I'm Nick Polari.
And we are the Boring Millionaires. So our goal is to help you understand finance and feel confident in finance. And we're going to just jump right into it. Today is December 20th. It's a Friday. The S&P 500 is trading this morning. It opened at 5,842, but now it's trading roughly at 5,972. Quite a move in the day. A lot of volatility going on, but it's expected given the trading week that we had seen. There was a lot of movement after the Fed meeting on Wednesday, and, it's shaking up the market a lot. But one thing I want to bring up to that point is we start every episode saying where the S&P and the NASDAQ is. The NASDAQ currently at 19,725, but that's lower than it's been every week prior. If you've been following all our episodes, the S&P has been basically above 6,000 the entire time. But now, today, we've seen it between 58.40 and 59.72. Just on a broad, looking from the outside in view, you could see right there that the market is discounted, and that's an opportunity presenting itself.
Again, with the Fed meeting and everything, the market took a little bit of a dip, so perfect opportunity. Everything's starting to recover, so it is a perfect time to get in.
It is. This week is the week that I like to feed on. So Wednesday, December 18th, was a Federal Reserve meeting. We had mentioned it in our previous episode. And what exactly happened in that meeting was the Fed did cut rates by another 0.25%. However, they originally, in the middle of the year, anticipated they would cut 4 times in 2025. Now they have their sights set on 2 cuts. Though they cut at this meeting, their outlook being brought to a more negative standpoint is where the damage came in the market. That's what set us off course.
Especially, too, when you're looking at that less cuts, they think that the economy is not going to be doing too strong in the next year. So also you do have to be careful when you're cutting too much or too little. If you cut too much, you can actually fuel inflation. If you cut too little, then you don't have enough money going out, you don't create enough growth, and then it also hurts the economy. So it really is a delicate dance that they have to play where they could really screw everything up.
It is, yeah. So the Federal Reserve, both in the direction of raising rates higher as well as lowering them, they need to go at a proper pace. Otherwise, they really can disrupt a lot of what we see in the market and create volatility. And we even saw it on Wednesday, like we just mentioned. That one negative outlook, kind of regressing what they thought they would be doing, set in the biggest drop that we've seen in months, frankly. And it's been 2.5 months since the S&P 500 saw a greater than 1% decline. And, that's huge. It's good on the way up. But as far as the market being a healthy organism, which it truly is, we need moments and days like we saw on Wednesday. So as fearful as it is, on the surface level, it is very necessary in the health of the stock market.
But also, too, like we said, opportunity. That's why we always say buy the fear. It's already starting to make its way back. So, that little dip, it scares you. I know I looked at my account on Wednesday after the meeting. I was down a good 4%, and those numbers don't look fun. But also at the same time, there's a lot opening up. There's a couple trades I've made with this. And there's actually a couple stocks I've been looking at because of this. So it's perfect when it does this. It's scary, but you got to buy the fear. So
absolutely. It's moments like these where people truly build a strong portfolio in the stock market. And we've mentioned in basically every episode prior, buy the fear, buy the bad PR when things look ugly. This is bad PR for the economy. And the stock market and the economy are 2 separate beings. One does not correlate the other. They swim in the same ocean, but one is not a measurement of the other. But with all that said, the Federal Reserve's negative outlook was bad PR for the economy, for the stock market collectively, and that played effect in the prices and the price drop that we saw on Wednesday, opening for nothing but opportunity.
No, exactly. Also, too, one thing I looked why they might not be cutting too much next year, I was looking at the GDP they expect might fall with all the tariffs and everything. So that might not even happen. So, it's just an outlook. So we'll see what happens when the year actually comes.
It is an outlook. So it's just their hypothesis of the time moving forward. It's not a guarantee. And then on the contrary, we saw them promise 4 and move to 2. The market reacted negatively. They can now run with the anticipation of 2 and then put in their 3rd cut by August. Then the market will play catch up a little bit. So to the point you made that they need to act appropriately in their moves, I mean, that would be a little silly that they're saying one, doing the other, bouncing all around. But they are the powers that be with that. So they can decide as they want.
Exactly. And also, too, again, with it just being projections, you never know what's going to happen. The GDP could even go higher, and they could realize, hey, we could cut, again, the inflation could come down more instead of go up, because I think they had some fears of that also. I mean, anything can really happen. You can't really predict what the world's going to do, but we'll see what happens as the year goes on.
Absolutely, yeah. The Federal Reserve is never going to make their decisions on the anticipation of an economic climate. So, you know, we are very optimistic in a Trump presidency, a month from today, in fact. But the Federal Reserve is not going to bet on that. So they might see 3, 4, 5, 6 months into his administration and his presidency, things are good, to your exact point. GDP's looking like it's going to be better. Let's just start cutting now. They're not going to move off anticipation, but, you know, the time could turn around where, you know, they get a little more eager in their movements. And one more point I want to touch on with the big drop that we saw on Wednesday was the volatility index. So it is an index just like any other, although it is a little bit different in what exactly it's measuring. We've talked about the S&P 500, the NASDAQ, the Dow. Those things measure the market of stocks and the performance of the health of the market and things of that nature, where the volatility index is just a fear factor. For lack of better words, it is an index that measures the tense animosity in the market, who's fearful, who doesn't want to go first, just the tension in it. For lack of better words, it's just the tension in it. And just to track that tension, Wednesday afternoon, when the market, or I should say Wednesday morning, when the market opened, the volatility index was at 15. Then at the height of the fall on Wednesday, it was at 24. Now, today, just 2 days later, basically, we're at 18 again. So it was just a quick spike up, spike down, all of it squeezing out at once. That is a tremendously good sign for the drop that we're looking at. I think the lows are in. I very confidently think the lows are in.
No, I agree with that.
And just to say it on a trading or technical analysis standpoint, we fell to 58.40 was basically the lowest. The previous record high was 58.75. So old highs create new lows, and we saw that right in that moment. It's not going to be to the penny, but it's, you know, roughly right in the range. And then the 3-month average, which we've talked about a lot as far as trading, is 59.25. So it went right under, bounced around at that old high. Now today it rallied right above. It went straight through that 59.25, and that's an incredibly good sign that the market's going to recover. So between that health in the S&P and the volatility immediately shrinking after 2 days of squeezing out and getting crazy, that is almost a certification saying this market's going to rally right back to record highs.
No, exactly. Like you were saying, too, old highs. I mean, it creates kind of a floor, a safety net. So it usually will save around there, and then, you move. I mean, that's really what depends. If it falls under that floor, then you have a little trouble, but most of the time it usually stops and then starts making its way back up. So.
Exactly, and you raise a great point. I am certain that we're going to rally to record highs after these lows, but you need to prepare for every instance that can happen. And a floor is exactly what it actually is called, but when you look at a floor, you always look at what the next floor is, what the next resistance would be, which would be the levels looking on an upward trend. And that's exactly it. When we were looking at it, we saw that floor at the 58.75 mark. You could go a little bit lower to the 6-month average, or, you know, the resistance could be at that 59.25. And if it sat there all day and weakened up and then closed at 59.10, that's weakness. That's showing it sat at that number and couldn't do it and weakened out.
Yeah.
But we're not seeing that. It did the opposite. It flew
it just
like crazy.
Like you said, it's just a lot of fear, especially with the volatility index. I mean, obviously it's going to go up. There was a lot of sell-off. So volatility, when things move at a very fast pace, or it's kind of honestly like bipolarness. It just shoots all around. So it's not a good thing to be volatile. It is a little scary because when things have more of a hold or a steady growth, you have more safety in it. When it's more volatile, I mean, it could go from $5 to $3 to $6. It's all over the place. So with the volatility index returning, there's a lot more strength in the market. And yeah, I agree with everything you said with how I believe we'll be in record highs also.
Yeah, it's right around the corner, and as the volatility shrinks, it just calms everybody's nerves. The real deal professional investors and traders and people who manage investment funds with billions of dollars, they're going to look at the volatility index as a measurement of general safety. And the stocks that we typically invest in and aim for and have our eyes on, they are the safe stocks. They're the less volatile stocks. We're not going to typically buy things that would go from the 5 to the 3 to the 6, but sometimes volatility just meets the market. And regardless of what you're invested in, how safe it is, how proper your discipline is with your investing, sometimes you're just met with conflict that you cannot avoid.
Yeah, no, sometimes it's inevitable. So don't be too scared. I mean, if you're invested in those strong companies, the volatility might be there, but in the long run, you will be safe. So.
And I would just like to say, on a personal standpoint, I feel Nick would agree, I've built a career on weeks like this, where the market just falls apart, it looks terrifying for no reason, and then it just rallies right into record highs. Not always record highs, but it just recovers from the dips that are presented to us. Like this week, and everything I've just explained, I've done 100 times, and that is how you build a career in the stock market, is buying stocks in moments like this.
And also, like you said in previous episodes, you don't really want to buy at record highs.
Of course.
So this is the perfect time to get in because of these dips. So yeah, it's a good thing when it falls.
It is. And with the holiday season, just to kind of set a real life example, everybody just did their Christmas shopping. I think Hanukkah is the same day, actually. Everybody did all their shopping, everybody's shopping. However, if you had done all that Christmas shopping with all the same items, but everything was at a 5, 10, 15% discount, you're already shopping. You're getting it at a better discount. You're getting it at less expense to you. So if you're already intending on investing and building a nest egg and building a portfolio, it's moments like this that you're doing the same exact thing at a cheaper rate.
Yeah, exactly. I mean, that's why everybody looks forward to like Black Friday, Cyber Monday. That's why people used to get trampled on, because people love to save money, and this is just a perfect way to save money. So
it is. If you're buying a $100 stock, for example, and it's $95, you got $5 now. Go grab a coffee.
Exactly. Yeah, you have extra money to put where you want. So I agree with that. I mean, I've brought up the Apple story a million times, how I got into Apple. I mean, there's plenty of examples on dips. I'm currently trying to ride on a Dollar Tree dip right now. So yeah, it's just it's the time to do it.
Yeah, it is. It absolutely is. And speaking of the time to do it, I have my $50 budgeted out. I'm going to take $10 of that 50 and put them into 5 different companies. Just get a little bit of it. It doesn't need to be a whole share. But the 5 companies I'm picking this week are IBM, JP Morgan. I've picked Unity Software, Intuitive Surgical Robots, and 3M. So Unity Software, they make basically half the games that we all play this generation. We all game, so I'm sure you know Unity. They're a powerhouse software company, and I think just the direction that AR, VR, all gaming stuff is going in, they're at such a cheap discount that you're stealing them almost. IBM is a fantastic dividend. We've talked about dividend income before. JP Morgan, I've mentioned that I bought it in previous episodes. There's no reason why I can't buy it again. It is presenting itself at a great discount. We just talked about the Federal Reserve cutting rates. They're going to benefit from that, directly benefit from that. And like I said, they pay a great dividend. So all signals good. I'm just rebuilding my position in JP Morgan. I don't need to buy it once. I don't need to sell it once. I'm just creating a position in a company that I want to be in. And I just want to touch too on 3M. They make everything you buy in Home Depot, they manufacture. Every work tool, work gear, work everything. They make everything. They make tape. They make everything, just to say it again. So with that, though, a lot of their products are sold in China. And I think that with the new administration that we're going to see, we're not going to be best buds with China, but we're going to be able to do commerce with them at a civil level. And I think they're going to benefit from that directly, as well as having another great dividend. So all 5 of mine, just great stocks, things I've been involved with for years. and 3 of which IBM, JP Morgan, and 3M all pay great dividends. So
No.
you can't go wrong with that.
Yeah. One thing on the 3M thing, I remember a couple years back, I might be wrong on the number. On the website, I think it said they have like 25,000 products.
It
or
was
something
something.
like
I remember
that.
we
Yeah.
looked one time.
'Cause it's a huge number. So, yeah, they really have everything.
They do.
So.
They absolutely do. Just for fun, go in a hardware store and just look at who made whatever it is you're looking at.
Well, also, too, sidebar, I was in Walmart and I picked up like command hooks 3M right on the thing. They
there
had
you go.
A whole aisle.
Shelving.
Everything was just 3M.
I need
like,
them for
on
my
the corner.
Funkos. In fact, there you go.
But also, too, I do want to run back to a point you said. When you're doing these $50 and, again, the whole share, yeah, you don't need a whole share. And also reinvesting in companies you've already invested. You don't have to always buy something new. When you reinvest into something, one, you're building more shares and eventually you will have that whole share. But also your money's in there. You have more money that you can grow in the company. And yeah, you don't have to always be buying new. It's good to double down on stuff that you have. It's good to build stronger positions in what you already own. I have my $50 list. I have actually, it's funny enough you say this, I have IBM also.
How about that?
Great stock.
Must be a great stock.
Yeah, exactly. Yeah, great dividend. Like I said, it was the first one I ever bought. It's trading around, I think, like 225, 227. So it is
Yeah.
a strong one. Another one to kind of take a play from your book from last week. I have United Healthcare because
Okay.
it did have a dip. So, I mean, why wouldn't you buy it? Boeing is also another one. I've held this in my other account. Just had a $5.85 billion deal. So that's also going to look good
With
for the
Pegasus,
company.
that is,
Yes,
right? Yeah,
airlines.
Turkish Airlines. So
So-
just getting back in the game.
I have Meta because, I mean, Facebook, Instagram, they're moving into VR. They have the Oculus. They're moving into the AR territory. So, you know, you can't go wrong with them. And then Walmart. It's just Walmart I've talked about before. I think it's great to own. I mean, everybody goes to Walmart. And also, too, when they had earnings, they beat earnings. So it's just a strong company that I think will grow over time. So I would like to invest in it.
I stand behind all of those picks. They're phenomenal companies. I have shares in all of those companies. But to focus in on the point that you mentioned about building your position, some of these have been mentioned in previous episodes on both our list. You mentioned Walmart before, but you're investing in the company and you're being a part of that company. So it's rather than buying all the new things, like you said, you almost get lost in the woods, that you have all these stocks, you need to keep track of all these different things and what they're doing and how they're performing, when you could kind of just keep a nice little caravan of everything organized. You know, even just pick your 20 favorite stocks, follow those 20 stocks, and then every week, whichever one is at the greatest discount or presenting the most opportunity, you know, that's the one you pull the trigger on.
Yeah, just put a little more money in. No, I agree with that. It is nice to have that foundation, and also if you're already investing in it and you have faith in it, why wouldn't you put more faith into it? So it's always good to just look and evaluate what you have and then see what you want to build on.
Yeah, and just an example in my own personal investing life, Visa was one of the first things I've bought, and I've probably rebought Visa more than any other stock. It's fantastic. We've mentioned time and time again how great they are, as well as MasterCard. They monopolize the credit market. But the point I'm getting to is whether it was 2014, whether it was the summer of 2015, whether it was 18, 20, whenever, I want to own Visa. I want to continue to own Visa for the reasons I like that stock. So any discount is just an opportunity to further that position.
No, exactly. Especially, too, if you invest in a company, it has great growth, and you're like, oh, like, maybe it's getting a little away, or maybe I should have bought more at that time. When it falls a little, it opens so you can get back in.
Yeah.
So.
Always presenting opportunity. And with that, we hope you are gaining resource in what we're trying to express. We hope you take advantage of the market discount that is presented in front of us. You could follow us on Facebook, Instagram. We're going to continue moving forward with all our other social medias. And we just want to get you to understand how to capitalize on moments like this. Speaking for myself, I took advantage of the fall on Wednesday, and I know in 3 weeks, everything I bought is going to be A1 steak sauce. So we're trying to teach you how to identify these opportunities and capitalize on them.
Yeah, no, we're just here to help. So, again, if you ever have any questions, anything, you can leave us a comment. We will answer them for you, and we're here to help. So we'll see you for the next episode. Thank you for watching.
Thank you for tuning in. We'll see you soon.